You've seen the headlines by now: BRICS, gold, a secret plan, a currency reset, some version of the dollar is finished, packaged into a 10-minute clip with dramatic music and a countdown clock. And if you've clicked a few of those, the algorithm has probably decided you need 50 more by the end of the week. Today, I want to slow this down. Because underneath the hype, underneath the breathless claims, there's a real structural development happening. It's not a collapse narrative, it's not a get-rich-quick trade, but it is something serious market participants are quietly positioning around. Specifically, the idea that roughly 40% of newly mined and official gold flows are becoming effectively locked inside BRICS and aligned countries, outside the Western financial system. Not confiscated, not weaponized, just not available. That's the 40% lock. Almost no one is explaining it cleanly. In the next hour or so, I'm going to walk you through what the data actually says, what it doesn't say, how this could matter for gold prices over time, and how I'm personally positioned. Calmly, with probabilities, no hype. If you're new here, welcome to Financial Briefing. This channel exists to filter signal from noise in macro, metals, and markets, and to stay accountable when we're wrong. Let's get into it. Before we dive into BRICS and gold, I want to start the way we always do here, with a quick scorecard. Back in late 2023, when gold was trading around 1950, we said that central bank demand would likely keep prices supported even if real yields stayed elevated. We did not call for a breakout. We said base building between 1900 and 2100 was the highest probability path. Gold spent most of 2024 doing exactly that. In early 2024, when silver briefly spiked above 30, we said the probability favored a pullback into the high 20s before any sustainable move higher. Silver retraced to just under 27 within 6 weeks. That wasn't popular at the time, but it was data-driven. And last summer, when several channels were calling for an imminent dollar collapse tied to BRICS announcements, we said the dollar index was far more likely to chop sideways than crash. Since then, DXY has stayed largely range-bound between 100 and 106. We don't get everything right, but we track what we say, and we adjust when the facts change. That's the mindset we're bringing into today's discussion. So let's talk about this so-called BRICS gold play, starting with the first data point that actually matters. The number is roughly 40%. Depending on whose estimates you use, BRICS countries plus aligned partners now account for approximately 40% of annual global gold demand when you combine central bank purchases, domestic mine production retained locally, and retail investment flows that do not re-enter Western markets. To put that in context, a decade ago the figure was closer to 25%. What changed? China and Russia dramatically increased domestic gold accumulation after 2014. India's retail gold demand rebounded structurally post-COVID. Countries like Turkey, Iran, and several Gulf states began settling more trade outside the dollar system. And crucially, much of this gold is not flowing back into London or New York vaulting systems. What this means is that a growing share of a gold supply is effectively removed from the float that sets marginal prices in Western exchanges. What it does not mean is that 40% of gold is suddenly unavailable or frozen forever. Gold is fungible. It can move if incentives change. This is not a hard lock. It's a behavioral and institutional preference shift, not a legal barrier. Still, when marginal supply tightens, price sensitivity increases over time. The second data point is central bank buying. In both 2022 and 2023, central banks purchased over 1,000 metric tons of gold per year. That's more than double the annual average from the prior decade. Historically, central bank buying at this scale has coincided with periods of geopolitical stress and declining trust in reserve currencies. In the late 1960s, similar accumulation preceded the breakdown of Bretton Woods. In the early 2000s, emerging market central banks quietly increased gold exposure before the commodity supercycle. What it means today is that official sector demand is acting as a structural bid under the gold market. What it does not mean is that central banks are coordinating a gold-backed currency or planning an overnight reset. There is no evidence of that. Most of this buying is incremental diversification, not revolutionary redesign. The third data point is settlement behavior. Over the past 3 years, an increasing share of trade between BRICS countries has been settled in local currencies or through bilateral arrangements that bypass the dollar. Gold is occasionally used as a collateral asset in these systems, not as day-to-day money, but as a trust anchor. Historically, gold has often played this role during periods of monetary transition, not as a circulating medium, but as a balance sheet stabilizer. What this means is that gold's monetary relevance is increasing at the margins. What it does not mean is that gold is replacing the dollar. The dollar remains dominant in global trade, reserves, and capital markets. That hasn't changed. Now, let's step back and look at the bullish case calmly. First, if 40% of gold flows are increasingly held outside Western markets, then incremental demand shocks could have an outsized price impact that supports higher prices over time. Second, central bank buying provides a long-term floor. Even if ETF investors sell, official sector demand has shown a willingness to step in. Third, geopolitical fragmentation increases the value of neutral reserve assets. Gold benefits from that structurally. And fourth, mine supply growth remains constrained. New discoveries are rare, costs are rising, and permitting timelines are long. Put together, the bullish scenario is not explosive, but it is persistent. In this case, gold grinds higher over several years, potentially moving into the 2,500 to 2,800 range in nominal terms. I assign this scenario roughly a 25% probability. Now the bear case, which deserves just as much attention. First, much of the BRICS gold narrative may already be priced in. Markets are aware of central bank buying. This is not secret information. Second, if real yields remain positive and the dollar stays firm, gold faces headwinds. Gold is not like tight financial conditions. Third, gold held in BRICS countries is not permanently locked. If prices spike, incentives to sell increase. Supply can reemerge. Fourth, geopolitical tensions can cool. Markets often overestimate the permanence of political blocks. In this scenario, gold remains range-bound, perhaps oscillating between 1,900 and 2,300 for years, delivering little real return. I assign this outcome about a 30% probability. That leaves the middle case, which is where I think we're headed. In the most likely scenario, gold gradually reprices higher in fits and starts, driven by structural demand, but capped by macro constraints. No reset, no collapse, just a slow re-rating. Prices drift higher, volatility remains, and gold fulfills its role as a portfolio stabilizer rather than a speculative rocket. I put this scenario at roughly 45% probability. To understand why this feels familiar, let's look at history. In the 1970s, gold responded to inflation and monetary disorder with a dramatic revaluation. But that period featured negative real rates, wage price spirals, and an explicit breakdown of a fixed monetary regime. Today, we have some similarities. Geopolitical stress, debt accumulation, but also major differences. Central banks are more proactive, financial markets are deeper, capital controls are more subtle. A closer analogy may be the early 2000s. Gold rose steadily for a decade as global imbalances accumulated without a single dramatic catalyst. That's the lens I'm using. Now let's check cross-market signals. Gold today trades around 2,300. The dollar index remains range-bound. 10-year yields are elevated but stable. This combination suggests tension, not resolution. Gold is being supported, but not unleashed. The market is waiting. Positioning data supports this. Futures positioning shows specs are not excessively long. Banks remain net short, as they typically are, but not at extremes. This is not a crowded trade. So what am I doing? Here's my framework, not advice. If gold breaks above 2,400 on strong volume and real yields fall, I add modestly, increasing allocation from 8% to 10%. If gold falls below 2,100 with no change in structural demand, I add more aggressively. Currently, I hold about 8% in physical gold, 3% in miners, and 2% in silver. I keep stops wide. My mental stop on miners is roughly 20% down. My take profit on additions would be incremental trims above 2,700. What I'm not doing is panic buying. I'm not watching fear-based content, and I'm not assuming monetary collapse. This week, I'm watching three things. First, central bank commentary on reserves. Any acceleration is bullish, pauses are neutral. Second, real yields. A move below 1% would support gold. Third, dollar strength. A sustained break above 107 would be a headwind. To wrap up, here's the takeaway. Gold is being quietly accumulated outside Western systems. This is supportive, not explosive. The most likely path is gradual repricing, not reset. Patience matters more than predictions. If this kind of calm, accountable analysis is useful to you, consider subscribing. That's how we grow Financial Briefing. Thanks for listening. Stay sharp.